Hey everyone, welcome to another edition of Super Prime UK with myself, Rob Cohen.
And myself, James Wild.
Hope you're well. Another week, volatility, uncertainty, market activity. We are here bringing you live information, intel, data and insight of everything that's happening within the property market and what's going on in lending, banking and finance. James, another roller coaster every week is a roller coaster. What's been happening, what we're sharing, and what is the latest data?
Thanks, Rob. So in terms of the latest data this week, fairly good new instructions, 354, which I think is positive. Slightly telling this week, the price reductions, 299, so almost as many price reductions as new properties to the market. Just as Rob, I think as we enter this the final run of 2022, I think the market is softening somewhat as we head into quarter four. There, in terms of the under offers, fairly strong, 207 for this week, and also the sold figures of 172. So that's well above average for the year. So the market is continuing to function, and sales are still going through. It's just I think buyers are that little bit more cautious on making sure they're paying the correct price, and there's maybe a slightly less competitive nature of some of the bidding, with less stock going over asking price now.
I think with so much uncertainty in the market at the moment, you've got the people that are thinking, I want to get out and take advantage of strong pricing. Then you've got the people that are still thinking that they want the opportunity to get in. And there's this to and fro at the moment. And with all of the uncertainty with the government and the Bank of England, and we're waiting on potential U-turns, and we're waiting on another update from the government later at the end of this month. And everyone's playing this guessing game, and it's just a moment in time that's relatively unprecedented in terms of the daily updates and changes from the economic position, whether that's the government or the Bank of England. And for that reason, it's creating a challenge in the financial markets and the property market.
That's it, definitely, Rob. Just this week, we heard obviously that the UK for August was negative growth of 0.3%, as sort of the fears grow that we're sort of entering that sort of negative growth and possibly a recession, a technical recession, come the end of the year, with obviously sort of banking stocks being bought up by the Bank of England. Goldman Sachs this week as well, Rob, did voice some concerns over the commercial sectors and billions of pounds being potentially wiped off that commercial sector, with obviously the sharp rise in borrowing. What are your thoughts on that, Rob?
Yeah, I think the commercial markets returns and yields need to be gained for that to be an attractive market. The cost of borrowing, the cost of entering into that investment is critical to getting those returns and yields, along with income stream. And at the moment, maybe investors are taking the view that they want to wait and see over the next coming weeks what the government does, what the implications are for the cost of borrowing, and how it's going to affect their investments. So the commercial market at the moment a bit up in the air. Let's hope it's only a short-term position, and once the markets gain some confidence or more trust in what is currently happening, then the investment levels can return, and even if pricing changes slightly, maybe it won't be as dramatic as Goldman have reported.
Thanks, Rob. It's commercial property, so yield driven, isn't it? And obviously, there's sort of a lot of investors, their main sort of analytical compass is that net initial yield, obviously sort of netting off the purchase costs. But in terms of the present market, with it being those borrowing costs which are really soaring and aren't currently reflected in those yields, I'm not sure how they're making an adjustment for that in some of their investment analytics there. Moving on to the mortgage lenders and sort of interest rates on homes, following on from some of the sort of financial markets the past couple of weeks, some lenders have actually increased their rates as well on top of that, those rate increases on the base rate. So the average rate on a 2-year fixed, Rob, we're now up at around 6.46%, whilst on a 5-year fix, actually cheaper. They've swapped around in more recent times. 5-year average averaged fixed rate mortgage is 6.32%, which those figures are the highest since the previous financial crisis. Just to give you some examples, some spot examples of some of the lenders on their rates, what's happened over the past week. Barclays have raised their fixed rate home loans around 0.8%, whilst Halifax have increased pricing on their, the largest increase in pricing they've done is 1.29% on their home loans there. TSB have increased its fixed rate mortgages by about 0.5%, whilst Metro Bank have withdrawn all loans of 80% LTV for residential borrowers and those of 75% or upwards for the buy-to-let sector. So a real diminishing market there, Rob, in terms of what consumers, what choice they have in terms of their borrowing and available mortgage lenders for their sort of affordability criteria.
It's very simple. I've been speaking to quite a few of the major banks over the last week, and the banks get their money. The cost of borrowing for them to lend is at a certain price. The fundamentals of lending, that price has gone up. The government's cost of borrowing has increased, as we're very much aware. There has to be a margin in when the banks and lenders put that money into the market. They need a return, they need a margin, and ultimately that is going to affect the end user, whether an investor, a borrower, or an applicant, and ultimately that means that cost is only going to go up. So until the government manages its borrowing cost to then allow banks to have fund flows at a cheaper entry point, and for that to then go to the end user, whether it's a borrower, an applicant, or end user, the fundamentals of lending from banks require for that pricing to be where it is.
Thanks, Rob. And just wanted to bring a bit of high street news as well. I mean, most of the news is obviously price increases, Rob, are sort of almost across the board. Obviously, Ikea actually announced that it's going to be reducing some of the cost of some of its stock items as the supply chain bottleneck seems to have eased. The retailer did say that it's absorbed around £1 billion of cost increases, Rob, before it decided to increase its prices about 12 months ago, sort of 9% price increases across the board almost there. It's had quite a turbulent year in the retail sector. A lot of those large retailers closing business in some sectors in Europe, and obviously in Ikea's case, their internet sales have decreased around 10%. However, if we do go back in time slightly, about 5 years ago, their total sales revenue was only about 5% from online sales. The current standing is around 22%. So I think that data, Rob, just suggests a lot of the period over lockdown when people weren't visiting physical stores, and I think that has switched now. People are going to Ikea stores almost like sort of showroom for ideas and sort of space saving and configurations there. So I think it's one of those stores where it's a bit more of an experience rather than just a wholesaling of home furniture and items there. So I think that's a bit of a good news story there in terms of they are managing to decrease some of their pricing. We've obviously got the opening of their new store on Oxford Street at some point. That they've sort of reversed their model there as well in terms of out-of-town shopping to some of the city centre hubs which they're opening.
I really like this story. I think there's legs in this one. Really, really good story, this Ikea one. The first sign that supply chains and distribution that have caused so many problems over the last 12 to 24 months, that's affected pricing and meant costs have gone up. The first sign that is easing now, and it's been related into pricing. If that's a sign of things to come, I think it's really positive news. And if the rest of the market follows on and that has a cross effect in other industries and other sectors, I think that could be a really good sign. There aren't many out there, but I think this could be a turning point. And if distribution really has eased and timelines are coming down, and that allows for pricing to reduce because of that, I think that's a great, great positive. And I very much hope that that is reflected across multiple industries and sectors, especially within property eventually. So I think that's really good, a nice story, and I hope that's a thing that we can watch out and see a positive point moving forward. Just want to share with everyone the Eva Q3 show is coming out next week. It's a must watch. You must get that data. You must get that intel. It's a great show. Q3, it's our second Eva show. Focus on Germany and the pan-European market. So it's a great watch coming out next week. And if you're not getting the data for this show, make sure you get it. Make sure you subscribe and make sure you get all of the latest data and intel. Thank you, everyone. Really appreciate your watching and following, and we'll catch you all next week. Take care.
Thanks, Rob. Thanks very much, everyone.